What is a sole proprietor? It is one person who conducts a trade or business by him or herself. It's the easiest form of business to create and operate. In fact, every business is automatically a sole proprietorship unless the owner chose another business form, such as a corporation or partnership instead. When a client owns a sole proprietorship, you will report the net income or loss of the business on Schedule C.
There used to be a Schedule CEZ for smaller businesses that was simpler to use, as long as expenses did not exceed $5,000. However, beginning in 2019, Schedule CEZ has been eliminated by the IRS. You will have to refer to Module 3 for a more detailed explanation of Schedule C.
In this session, I intend to introduce you to the Schedule C. When you fill out the Schedule C, generally, you'll enter your client's Social Security number at the top of the form. In the General Information section, you'll enter a brief description of the business, the name, the address, and then the business code taken from a table in the Schedule C instructions. The last thing to enter is the company's Employer Identification Number, or EIN. Why would your client have an EIN? The easiest way to look at this is to recognize that the IRS tracks taxpayers by their Social Security numbers, but business returns are tracked by the Employer Identification Number, or the EIN. So if your sole proprietorship client has employees, he must have an Employer Identification Number by which the IRS can track payroll taxes. If the sole proprietorship doesn't have any employees and has not applied for an EIN, then the owner's Social Security number will suffice. Otherwise, leave it blank. All expenses must be written and paid within the tax year. These expenses can include advertising, insurance, telephone, interest, professional fees, leasing, travel, and supplies, just to name a few.
Also, he may keep a mileage log on his vehicle.
In this case, you'll need to fill out the part of the form providing information on your client's vehicle. You'll then include the mileage allowance as part of the expenses in Part 2. Quite often, particularly with new business owners, they will want to deduct the money that they drew out of the business for personal use. For instance, imagine that the owner draws out $3,000 for a quick family trip to Disneyland. Can't you deduct what he drew out as an expense? The answer is no, because we've never shown the money as income to the owner in the first place. Money the owner takes from the business for personal purposes is referred to as a draw and not an expense. So if your client had revenue of $10,000 and expenses of $4,000, plus he drew out of the business $3,500 for personal reasons, he will still report $6,000 of net income from the business. How and when the owner draws out the $6,000 out of his business is up to him and does not impact the taxability. To arrive at the income that you will transfer to page 1 of the 1040, you will subtract the expenses from the revenue. If the amount is less than $400, you don't have to report the income and won't need to attach Schedule C. However, it's a good idea to keep the unneeded form in your files in the event there are questions later.